Hey YouTube, this is Zach with Achilles Financial. Today I want to highlight the relationship or what I'm watching between the NASDAQ 100 as well as the overall market, and inclusive of this is the conversation associated with bond yields. Something that we were discussing and evaluating over the course of the past year. Really, the last time we had a more in-depth conversation associated with this was back in April of this year, as we were talking about the relationship between bond yields and stocks, in particular more speculative stocks. Since that point in time, you can see a pretty significant rise. I'll put it on the year-to-date chart. We've seen a huge rise since kind of this April-March timeframe of when we started covering some of those bond yields, and why we saw the collapse into March, and why we're seeing some of the volatility in tech primarily here. A lot of the market sell-off, when we look at the Dow Jones in particular over the past 2 days, can be directly correlated to the latest iteration of, or the latest variant of COVID, and I believe that that's pronounced the Omicron variant. The reason why I want to highlight that I don't believe that's the case on the NASDAQ side is because really, if anything, any form of lockdown news I would imagine would be bullish for software. And so the reason why we saw things like airlines, why we saw items such as the hotel and hospitality industry drop, is because of the potential for travel restrictions. And we actually saw some go in place in both Africa and in Europe. And so that is definitely outstanding. However, what's occurring right here is over the course of the past 3 days, you've had Secretary Treasurer Janet Yellen and the current Fed chair with Jerome Powell essentially say that they recognize that inflation is not transitory. They have highlighted some additional concerns with it, and they're currently pointing to the fact that they may need, or not necessarily Jerome Powell specifically, but other Fed speakers have said that they need to accelerate the taper. So what does that mean? So right now we're seeing the potential to have negative economic growth, have some pain. However, we need to raise interest rates to combat inflation. This is the exact same conversation I had in March of this calendar year, as well as we talked about this in November of last year. So we've got this relationship right here for the NASDAQ 100. It's primarily tech stocks that we're looking at right here. At the same time, if we go over into the bonds and CDs, we'll move this over here. And you can see the bond rates here on my screen. And you may look at something like the 7 to 10 year rate on the US Treasury, which is currently yielding about 1.4%. It's important to note that bond yields, or the bond market in general, is more than 3 times larger than the US stock market. The reason why I highlight that is because there is massive amounts of money in play when we talk about the bond market. If you own a employer-sponsored 401k, there is a very high probability that you own bonds as well. With the traditional split, this is not financial advice, but this is how a lot of funds will operate, is the split is going to be, if you were to take 0 to 100 and you take your age and subtract your age from 100, the remaining allocation would be the percentage that you would be in stocks versus bonds. What I want to highlight here is a bond is essentially a contract. So this is not a stock. When these rates move, it doesn't change what you are purchasing. If you were to go out and purchase the 10-year treasury, you would purchase this money, and every year you would get 1.4% of your original investment for the amount that you paid for the bond. So if this rate tomorrow goes to 1.5, if it goes to 1.3, that wouldn't matter because the contract that you entered in would be for 1.4%. So what that means is this is viewed as a relatively safe investment. So there are a lot of individuals on Twitter, there are a lot of individuals on other social media who talk about why would anyone ever buy bonds when we have to beat inflation. The current inflation numbers from the Fed are north of 5.5% to 6%. So why would we ever go for something that's only paying 1.4%? And the answer is, and what a lot of big money is doing, is they're taking away a lot of the speculative nature of these stocks. So take into account Microsoft. Microsoft has been around for years and years and is just absolutely dominant in their space. So I'll put this on a 20-year chart. And you look at this and it is just straight up. Company has just absolutely killed it over the years. I would highlight, even though in 2008 they traded at $33 a share, in the bottom of 2009 they were dropping down nearly, or really more than 50% during that time period. So that's a massive drawdown over that point in time. What we've seen over the course of the past 3 years is a huge acceleration in equity valuations. So there are a lot of high net worth individuals, there are a lot of fund managers who are saying we are not interested in repeating another 2009 in terms of equity valuations. So you take a look at a stock like Microsoft, which is doing very, very well, but you look at their valuations and they're still growing very rapidly. That's quarter over quarter for revenue, still growing at 20% over here. But then you look at the valuation. From a price to earnings perspective, they're trading at 37 times earnings. From a price to sales perspective, trading at 15 times sales. These are very high valuations. That means that there is a lot of speculative nature associated with the overall price for Microsoft. Now keep in mind, Microsoft is a company I expect to be here for another 10 years. I don't see any reason why they wouldn't, even though there is, or they operate in software and software is constantly changing. But what I'm trying to highlight is that this is a stalwart. During 2009, they dropped more than 50%. If you have a lot of money, you do not want to go through a 2009, especially if you are on the back end of your working career and you're looking to retire. And so you are going to say, if I have all of these massive gains that I've received in the stock market over the past 18 months, a lot of big money is going to be moving into the bonds or other derivatives, even CDs, because they know that it's safe. If you have $100,000, if you have $1 million, and you do not need to take that out immediately, you can still get, if I'm looking at the 5-year, you can get still $13,000 a year for 5 years at a very safe investment. That money's not going anywhere. If you don't believe me, I will reiterate that the bond market is currently more than 3 times larger than the US stock market. So there's all this money going into this. That money may be coming from more speculative investments. So when we believe that the market is going to be overpriced, when we believe we're going to be raising interest rates, a rise in interest rates will correspond to a rise in US Treasuries and to a rise in bond yields. That's one of the reasons during the 80s, when we had crazy high inflation, you could get a CD and a savings account for 16 to 18%, even though your mortgage was 21 to 24%. So there were crazy interest rates at the time, but there were crazy savings rates as well. So that's what we're going to be looking at as we go forward, is the fact that as these bond rates go up, and you can see that we're staying flat here, as the idea that these bond rates go up, more speculative investments are going to be hit by profit taking. So you are going to see a lot of companies that have seen these crazy rises begin to normalize, I would say. Now, the companies that are currently loaded up due to margin or due to leverage, it is very expensive to maintain leverage when the interest rate is more than 0.5%. So when we see those interest rates go up, you're going to see margin requirements change. You're going to see margin payments change, at which point in time you're going to see a lot of deleveraging. The hope is that all of this occurs over a long period of time and not in an immediate switch that would cause a lot of instability in financial markets. However, we've seen that instability during the 2008-2009 time period, and we did see a bubble pop in the tech sector in 2000. So what I'm going to be watching forward is the inflation rhetoric, is the verbiage that's being quoted to us by the Federal Reserve, and see what the expected impact is going to be. And that's how I'm going to drive how I trade tech stocks, as well as how I continue to evaluate the bond market, which I am personally not actively investing. I'm sure that I have some in some of my passive 401k accounts through my employer. But all of this is, again, just my opinion. I'm some guy on YouTube, but these are the items I'm watching. And that's the relationship, or my perceived relationship, between what we see with the tech stocks and with the bond market. If you have any questions, feel free to drop those in the comment section down below or in the Discord linked in the description. Free to join, free to chat, and we'd love to have you there. So if you find this content helpful, please leave a like and subscribe. Thanks. Talk to you later.